As a business owner or operator, when you are shopping for money, when you're shopping for growth capital for your business, essentially you have two broad options: debt and equity. Think of them as two buckets of money available to you. Debt is money that you borrow, equity is money that is invested in your company. Two sources of capital, growth capital for businesses today. And when we think of debt, it could be a traditional bank loan that you would pay both principal and interest on. It could be some loans are based on revenue, and as you generate revenue, you're able to borrow more money, which means then you're paying more interest. There's what's called factoring, where you borrow money to finance your receivables, money that are owed to you by your customers. And factoring is either the selling of those monies that are owed to you, or you're being lent money based on those receivables. So there's a variety of different types of debt. Equity, same thing. There's money that you put in the business as the owner, money that family, friends, relatives might invest. There is are called angel investors. These are individuals, high net worth individuals who like investing money in typically young growth companies. Then there's venture capital, there's private equity, the list goes on. And in addition to that, there are now multiple options for both debt and equity, online capital. There are platforms where individuals like you and I can either lend money to companies or invest in companies. And there are also online sources of companies that will invest money or lend money to small businesses. So again, the options have gone up dramatically over the last decade, both for debt or equity. Which one will you choose? Well, there are a number of factors that I think go into this decision. It's not an either or. As we talked about when we looked at the ratios, the debt to equity ratio, it's usually some mix of both money that you borrow and money that you take in as investment. And remember, we said the average is a 1-to-1. Half of your capital coming from borrowing, half coming from investment. But what other factors come into play in making this decision about what's referred to as your capital structure or capital mix? Well, maybe a couple most important. One would be the cost of the money. If I go to borrow money from a bank today, the interest rate on that loan today would be around 8% or so from a commercial bank for what's called a term loan, over a period of a year or more. About 8% or so. So I would weigh that. Let's say I'm looking to buy, I don't know, a piece of equipment. It's going to cost $1 million. So one option would be go to the bank and try to borrow that money. Another option would be to look for investment capital. Again, either my money as the owner of the business, putting my own money in, or getting others to invest. Well, how much does that cost? Well, if I'm an investor and I'm looking to put money into a small business, typically my expectations would be maybe 20 to 25% return on my money, because it's not necessarily a safe investment when you invest money into a small business. So there's some risk attached to it. So my expectations in terms of return are higher. So if an investor is expecting 20 to 25% return, that means as the company, my cost on that capital will be the same, 20 to 25%. So I can go to the bank and pay 8%. I can look for investors and pay 20 to 25%. Clearly, in that regard, I'm better off borrowing money. It's less expensive. Generally, debt capital, less expensive than equity. Another factor that I have to think about is the risk associated with each source of capital. Let's think back to the bank loan. If the bank lends me money, is that risky to me as a company? Yes, because when I borrow money, I sign a loan agreement, a legal document stipulating that I will pay this money back. I guarantee I will pay this money back plus interest. that there's some risk associated with that, good or bad, whether my company's making money or not. I got to pay that money back. Versus investment capital, if an investor puts money into my business, there is an expectation that they will get paid back and some return on their capital, but there's no guarantee. There's no legal document with an investor that says Tim has to pay you back your money. No. So the risk associated with debt is higher than the risk associated with taking equity financing. So there's an inverse relationship between the cost of each of these forms of capital and the risk associated with that source of capital. Inverse relationship. Several other factors that you would look at in shopping for money. You would look at, the use of funds. If it is just to provide working capital for the business, typically that's a bank loan, not so much in investment money. The market conditions. Are we in a strong economy, weak economy, inflationary, high interest rates? What are some of the external factors that would cause me to go to one source of capital or the other? The size of my company. If I'm a very large company, I've got greater access to either debt or equity versus a small company. The industry that I'm in, there are some industries that are more attractive to either banks, maybe being a safer industry, or investors, high tech or biotechnology, cutting edge technology that might be more attractive to investors than to a bank. Banks also like companies with safe rates of growth. Two things that scare a banker is, one, a company that has no growth or a company that is growing too fast. Where for investors, they tend to have a greater appetite for those high growth companies. So again, number of factors that come into play. The last one would be, how much money have we already borrowed versus how much money have we taken in as investment? That may impact my next decision in terms of looking for capital. Okay, so those are just some of the factors that come into play in shopping for money. When we come back next time, we'll talk about the 5 C's of lending.